April's rent payments crisis sparks fear of a real estate meltdown, with an estimated 15 million households could miss their future payments on their real estate if the economy continues to be closed off. If you want to know everything from living, dining, sleeping, buying, and selling in the Detroit Metro, hit subscribe and tap the bell because I have new videos coming out weekly. And I absolutely love when people call me, text me, or email me because they're thinking about buying or selling in the Detroit Metro. So if you have any plans to buy or sell in the Detroit Metro, call me, text me, email me, or even send the pigeon carrier because I've got your back. Almost a third of renters were unable to make payments in April, with calls for a federal pause on real estate liabilities, and that includes rent and mortgage payments. And even if mortgage and rent payments are frozen, the ripple effects of missed payments will be long felt. The developing housing crisis draws eerily similar to 2008's financial meltdown. With 6.6 million now recently unemployed in the US and nearly a third of renters unable to make rent for this month, a federal pause on rent and mortgage has been widely proposed. And now with an estimated 15 million households could miss future payments if the economy continues to be closed off. So no matter how many rent or mortgage payments are foregone due to the coronavirus, those missing payments won't go away quickly. They will have to be paid back at some point, and when that point eventually comes, it will put a hefty strain on the consumer's finances. And not only are homeowners and renters unable to make rent, but restaurants, retailers, and hotels are definitely feeling the pressure too. Nearly every state has issued the closing of non-essential businesses. No customers means no profit, what makes it a challenge to meet rent. So is this 2008 all over again? The effects of missed payments will ripple long after the fact. And we need to look no further than 2008 financial crisis for evidence of this. Back in 2008, people bought homes they couldn't afford, and most of these purchases were on borrowed money, also known as mortgages. From there, those mortgages were turned into securities and sold off as investments. And once the bubble burst and people couldn't afford to make their mortgage payments, the value of those securities fell drastically. Once the banks couldn't sell the mortgage-backed securities, they ran out of money and either sank or got bailed out. Now, $500 billion in real estate liability assistance already requested in the last 2 weeks of March, and around 2,600 commercial mortgage-backed security borrowers reached out to banks looking for $500 billion in relief measures. And bear in mind, that was for just the last half of March. If people cease paying rent and landlords can't pay their own obligations, they will stop paying their interest and principal on their mortgages. From there, banks would start seeing defaults and tremendous loss of money. And once the economy starts to show warning signs, it can cause a chain reaction as values of assets plummet. Banks also experience huge margins of loss when they so desperately only need growth. And who would be left holding the bag? The federal government and their current propensity for bailouts.